Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, Julia Lee of Berman Invest and Jun Bei Liu of Tribeca Alpha Plus Funds will look at companies that they like out of the recent reporting weeks. And then Ron Shamgar, who's the head of Aussie equities at Tamim Asset Management, assesses EML payments, Money3 Corporation and the Unity Group, and he actually likes these three companies. Finally, Paul Rickard raises his price target for Telstra and looks at today's reporting companies, Ampol, Sonic Healthcare and Reliance Worldwide. They kind of reported pretty well, but the market didn't give them a big thumbs up. We'll try and work out why. That's the show. Let's kick off with Julia Lee of Berman Invest. Julia, thanks for joining us.
Great to be here, Pete.
It's reporting season, and I know that excites you when reporting season comes around. Let's look at the companies that have reported, you like them, and you think their share price will keep on heading in the right direction. First one you've talked to me about is BlueScope.
Yeah, I like BlueScope. I guess, Pete, the reason why reporting season is so important to me is that there's been a number of studies that have been done which show that companies that perform well during a reporting season and report well, that effect isn't just for that day or for that month. 6 months later, you've usually seen outperformance by those companies as well. So as a group, these companies do tend to keep on outperforming. BlueScope still is one of those which is in an upcycle at the moment. We're seeing very strong US housing activity. And not only that, the iron ore price has fallen, and iron ore is a key input into steel. So costs are falling for BlueScope Steel, but demand still looks quite strong. It is coming up with a dividend as well as a special dividend, which will be paid in September. So looking quite good here for BlueScope Steel. And I think importantly, the outlook looking strong as well.
And Julia, I must ask this question. Are you saying that a company has to report well and its share price has to rise, or can it report well and the market reacts badly to it, you know, on first blush, but later on it realizes a lot better report than they expected?
It's a good question, Pete. And I guess if you see both, it reports well and the share price rises, it's a much stronger signal than if it reports well and the share price falls. Having said that, you know, the market is a bit of a strange beast in terms of expectations and where valuations are. And I guess a case in point today is Sonic. It reported well, but the share price was down 2.5%. So I guess a key thing that we try to look at is how much is already built into the share price. We have a look at Sonic's share price. You know, it's up 25% in the year to date. And I guess investors are asking themselves, have earnings peaked? You know, Sonic is helping out with COVID-19 testing and as well as injections. So are we seeing a peaking of earnings at the moment? So I think if you see an opposite reaction to the result, then there's just a bit more uncertainty involved. Better to get both the signals.
Yeah. By the way, CSL had that kind of reaction, didn't it? That the market didn't necessarily like a pretty good report, but it has continued to sneak up ever since.
Yeah, I think, Pete, you raise a good point about the healthcare space, CSL. And I think the healthcare space and the information technology space are frequently areas where you do see results that are relatively good and the share price goes the other way. And that's because that valuations in these sectors tend to be quite elevated. So you're already going into earnings season with high expectations. Probably not so much for the tech space this time around. You're going in with relatively low expectations. So even if some of these tech stocks report on expectations, you'll probably see a rally in terms of the share price, but in previous years we've seen that. So I guess valuations are important because they tell us a lot about what's already built into the share price. And stocks with high valuations, not only do they need to beat, they need to pretty much determine that they're still in this up cycle. That is, that analysts are continuing to upgrade earnings expectations to help support the share price.
Okay, let's go to a couple of insurers. Well, one's an insurer, one's a sort of a broking business. QBE and Steadfast. You like both of those, don't you?
Yes, the insurance business is doing really well at the moment. We have a look at QBE Insurance. It has this beautiful combination of relatively low claims, and then you've got rising prices, so rising premiums. So their claims inflation, that is the rate that people are claiming at, isn't as high as the rate that they're increasing their insurance costs by. So premiums are rising, but cost inflation isn't rising by the same amount, which means margins are expanding, which is a lovely place for QBE Insurance to be. And we're seeing that globally with the insurers, that we are seeing double-digit gains in terms of premium prices. And of course, if you think about the insurance space at the moment, I mean, just to think of general insurance, you know, we're still paying for our car insurance, but we're not driving our cars as much during lockdown. So the insurers are in a bit of a sweet spot. I guess it would be great if we saw the investment portfolio also performing well, but QBE Insurance does have exposure to interest rates, especially over in the US and Australia. So as interest rates rise, the investment part of its portfolio will do well as well. So QBE, not only did it see a good result, but I think it's still in this upgrade cycle. The outlook's strong and it's looking pretty good. So I like QBE as an insurer. I also like Steadfast, which sells insurance. So you've got one insurance company and the other one selling it. And of course, when premiums are rising, the brokers are doing well as well. So Steadfast doing well.
Yeah, it's been a good performing company, hasn't it, over time? Get sort of a change of pace. Car sales. You like car sales?
Yeah, I mean, anyone who's tried to buy a car during lockdown will know that it's pretty hard to buy a car at the moment. So that's not only in the new car space, but also the used car space. And with household budgets still relatively strong, car sales are going well. So car sales was one that impressed this reporting season. But look, South Korea is a growth engine and that's going to continue to grow. So they're in different markets around the globe. So not only did they report well, but importantly, some of the markets outside of Australia are really starting to fire. So the next 12 to 18 months, the outlook looking strong.
Okay. Now, one company that you did like not too long ago, before New South Wales went in, or Sydney went into lockdown, was Kogan. And Kogan has had a nice run. And I believe you still like Kogan. But what happens in a year's time in Kogan? Do we all of a sudden say, enough of Kogan, no more lockdown, forget Kogan?
Yeah, that's probably what I'll do actually, Pete. With some of these COVID-19 stocks, I'm just very careful in watching when I think that the earnings outlook has peaked, because that means that the share price action, it's going to be a little bit more difficult. Kogan at the moment is in a sweet spot together with the supermarkets like Metcash, Coles, Woolworths, because of lockdown, Temple and Webster. These companies will continue to do well as long as the lockdown continues because we're at home. I'm not sure, but a lot of people do seem. I've ordered 2 stand-up desks already because it looks like I'll be working from home much longer than anticipated. And I'm spending lots of hours in the office at the moment. So look, these stocks are doing well right now, but I don't think they're forever stocks because once you have reopening, you'll be competing against some of those physical stores. Kogan, I think, is going to be an interesting one, Pete, because it reports tomorrow on Tuesday. And the last update that we saw from Kogan was quite downbeat. And of course, since then, we've seen the shares recover. So we do need to see a bit more of a positive update coming through from Kogan, and hopefully we'll see that tomorrow. But retailers in general have been doing well. Harvey Norman, which of course is also underpinned by its property portfolio, reports at the end of the month. So watching that one as well.
Yeah, I know Maureen bought Harvey Norman for a mere song, you know, when at the bottom of the crash. And she kept saying to me, should I sell it? Should I sell it? But it's done so well. And I kind of think he's got more upside. What do you think?
Yeah, I think Harvey Norman is a little bit different from the other retailers because of the property component of its portfolio. And look, property prices have been going absolutely crazy. So look, watching for a revaluation of that property portfolio together with some relatively good sales of things related to houses, because of course we have seen house prices relatively strong. So look, if you're comparing, usually you compare JB Hi-Fi to Harvey Norman. I probably prefer Harvey Norman at this stage only because of the property component of the portfolio.
And also he's earning a lot more money overseas than ever before, isn't he, Julia? And I guess overseas is opening up.
Yeah, I mean, it's patchy in terms of the opening up, but look, the overseas growth, they've been looking at places like Ireland and Singapore. And of course, that international growth has been a highlight of Harvey Norman. I think the last couple of reports that we've seen out of Harvey Norman, it has been that international expansion, which has surprised. So watching that international expansion as well. But I guess in terms of retailing, just watching once again, the outlook. And I think that's the key, because not a lot of companies have given outlook this reporting season. And especially, I think it's especially important with those companies that are benefiting from the COVID-19 situation and lockdowns, that we do see some sort of clear outlook to help that extra leg up in terms of the share price.
Yeah, thanks, Julia. That's Julia Lee of Permanent Invest. And coming up is Ron Shamgar from Tamim Asset Management. Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, joining me now is Ron Shamgar, who's head of Aussie equities at Tamim Asset Management. Ron, thanks for coming on the show.
Hey, Peter. Thanks for having me.
Pleasure, mate. Now, look, just is there a speciality in the sense that you like to go for mid to small cap companies with at Tamim?
Yeah, look, I mean, at Tamim, just briefly, we're a wealth management firm based in Sydney. We actually offer investors Aussie equities, international equities, property and credit funds. I am the head of Aussie equities, so I specialize in the Aussie equity funds, which I run. And I felt that over the years, ASX 100 companies had too much coverage, and I couldn't really add value to investors. Whereas outside the ASX 100, I get a lot of access to the management teams, and you get to find companies that are more kind of under the radar, which really sort of, I feel gives me an edge as a fund manager.
Yeah, okay. And because one company in particular that I've been watching and talking to, my followers about is EML. And I know you have a view on it. It reported last week. It's a company that was looking pretty good, particularly when it looked like the world was reopening before the Delta strain came along, and then they had a problem with the Irish Central Bank. But you kind of think things are heading in the right direction with EML, don't you?
Yeah, look, EML, we've held it for quite a few years. And as you said, they've had their ups and downs, unfortunately COVID, and then this regulatory issue, which wasn't really their fault. EML reported their results last Tuesday, as you said, and there was some positives and some negatives in the result. I'll start with the positives. The revenue came in ahead of guidance, which is really good, and EBITDA was at the top end of guidance. Cash flow was really strong, and the cash balance on the balance sheet is $140 million. So we have a very, very strong business here. Pleasingly, the GPR segment, so that's that reloadable segment, not the gift cards, which is sort of higher quality. That's now half of their gross debit volume and about 58% of revenue. So they're really kind of moving away from the gift cards. And the new business pipeline is, again, really impressive. They signed 2 programs every week for the last year. And their business future pipeline has over 300 programs that are worth over $10 billion in gross debit volume at maturity. And if they can win sort of 40 or 50% out of that, that's quite material. Now, the negatives were the FY22 guidance, which they gave. Now, whilst the sort of top line growth was still very solid, the EBITDA figure that they've given was probably about 15% below consensus estimates. And which is probably the reason why the share price got hammered. And because of that, and then I think as investors kind of realize, hang on, this is just a transitory issue, it recovered. And so the biggest drag on EBITDA is obviously the regulatory issue that they have with the Central Bank of Ireland. And that's doing both delaying launch of new programs and adding additional compliance costs to the business. But management is saying that it will be resolved by the end of this calendar year, which will enable them to sort of keep going and launching new programs. And I think if you take a bit of a longer term view beyond FY22, which is what we're seeing investors starting to, the future looks really bright for this business. The world is moving to digital payments, away from cash, mobile payments, and all these solutions. And EML really is at the forefront of innovation in this space. So we really like this business.
Yeah, I must admit, when I first got interested in the company, there was the gift card business, and then was the casino or the gambling type relatable cards, and then they started adding more and more other financial innovations. I thought, okay, clearly the gambling side, if you ignore the online aspect of it, and the going to shopping centres, all a troubled year 2020. Figured in 2021 things would get better, but of course the Delta strains come along. So I roll my optimism now to 2022. And so are you seeing like the three components that stand out in this business or are likely to be heading into a more positive direction in 2022?
Yeah, definitely. And I think more importantly, I think unlike some other payments companies, and I know sort of, you mentioned gaming and so on, but it's actually a relatively small part of their business. They're actually diversified across many different industries, sectors, and customers. So there's no real concentration risk there, which unlike some of their competitors, I think it's a real positive. And I think sort of management has shown that, with COVID, which was obviously a big impact, and even this issue with the CBI, I think management is sort of showing investors, look, whatever sort of comes up against us, we can sort of handle it and resolve it to the benefit of everyone. They've shown it. And I think in the future, as problems arise, which they inevitably do, I think investors will start giving management the benefit of the doubt that they can deal with any issue that arises. And maybe we won't have these severe share price reactions in future. Okay. So, yeah.
Let's go to the next one you're looking at, and that's MNY Money 3 Corporation. These guys are kind of in the car finance space. Tell us why you like this company.
Yeah, so they actually started sort of as a payday lender back in the day. And, new management took over the business and pivoted it away from their payday lending, which they exited completely a few years ago, and focused purely on consumer loans to finance vehicle purchases, both secondhand vehicles. And then more recently, they've expanded into financing newer vehicles, and sort of larger purchasing prices of sort of up to sort of $50,000. They made some acquisitions over the years. Now, unlike some of their sort of emerging, lenders in this space, they're actually highly profitable. So they have a loan book which finished the year at $600 million, and their net profit after tax came in just under $40 million. They have a really strong sort of diversified funding base. They finally have their entire funding base to lend coming from sort of some of the big four banks and large financial institutions. So their cost of funding has really come down. Now, we've seen what's interesting is that obviously Australia has been a bit of a mixed bag in terms of COVID and lockdowns and so on. But generally, although our international borders have been closed, domestically, we've had a pretty good run up until now. In terms of being open and without COVID. And so, a lot of Australians, they couldn't travel overseas, and they chose to travel domestically, both for holidays and both to just commuting back to and from work, picking up the kids and so on. And people are a little bit avoiding public transport because of the perceived risk of COVID. And so using more cars, requiring more cars. And we've seen really the second-hand vehicle market and prices go up significantly, which benefits Money 3 because they just end up lending more money. The value of the car goes up, which means that the profits go up. And more interestingly, during the lockdown period last year, their customers actually ended up sort of paying off their debts a lot quicker rather than having defaults. So they had very strong cash flows. Now they're targeting in the next 2 years to reach $1 billion of loan book, which should equate to something around $70 to $80 million of net profit after tax. I think their market cap is somewhere in the 600s. So, if they can achieve that over the next couple of years, I think it's really cheap. And I would compare them more to a credit corp type business. And that business is trading on a 20 times PE. Money 3 is maybe on 15 times. And they've really established a long-term track record of growth. And I think it's a really good sector. And the industry is huge. And they've only got like 2 or 3% of the market. So they can easily double that over the next few years. So we really like that business.
An interesting business. I guess it has been helped by, as you pointed out, the lockdown scenario and whatever. But still, it is interesting when you see the sorts of people that borrow for second-hand cars in particular. There often are people who really need the cars and they will make their payments. It surprises a lot of people when you start looking at the demographics. One final one, mate. You want to look at UWL, Unity Group. Why do you like this company?
Yeah, so they actually haven't reported yet. They're reporting their results, I believe, Wednesday this week. This is basically a telco fiber provider to residential sector. So essentially, it's a mini NBN. So if you want to own the NBN, but a much better, well-run, profitable NBN, then you own Unity Group. Now, they are really the main competitor to the NBN in Australia. And our understanding is that they're winning about 20 to 30% of all new greenfield development sites in Australia. So they're actually giving the NBN a good run for their money. Now, we've seen a very strong housing market, and that should continue. Obviously, there are some setbacks in the short term because of lockdowns, but, they are basically what they do is, they win a sort of construction project with a developer, and they're contracted to roll out fiber to those residential lots as they being built and connected and sold to someone. And then they basically lease out, just like the NBN, that fiber to an internet service provider like a Telstra or whoever, who then provides internet to that residential owner. So they have a huge pipeline of contracted lots for the next 5 years. And if that business actually never did anything else, but just execute on that contracted pipeline of lots to connect, they would double their earnings, which is quite amazing to say for any business. And this is a very profitable, a very defensive earnings stream, highly cash generative. And we've seen a lot of, whether it's super funds or other players in the space, really covered these infrastructure type defensive assets. And funnily enough, Unity Group last year acquired their biggest competitor at the time, which was called Opticom. And they had a bidding battle against Aware Super. And Unity ended up winning that takeover battle. And it just shows that these super funds are really interested. And I wouldn't be surprised seeing Aware Super or someone else come and bid for Unity down the track. So the consensus EBITDA for Unity Group is $130 million for FY22. We believe that the run rate at the end of July is that number, which means that we should see consensus upgrades following the results. And so I think, it's just a quality, profitable business. And the guys that are running it are the guys that build Vocus, MTU, telecommunication, Vocus, and so on. So a really impressive board and management team. So just a really solid business.
Is Vaughan Bowen a part of that group?
Yep, Von Bowen, Mick Simmons, and there's a few others there. Yep.
Yeah, Vaughan's one of my ex-students from the University of New South Wales. I'm interested about that. Ron, but interestingly, the analysts think there's 21% downside, but is that because the share price has gone for a pretty strong run?
Yeah. I think there's expectations of an upgrade. So obviously it's starting to get built into the price. I think most sort of valuations out there are sort of $3.80, $4 and so on. But I just think we'll just keep seeing consensus upgrades. And look, it's probably trading on an FY23 EBITDA multiple of 18 times. But really, if you think about it, this is as defensive as a business can get. This is the fiber backbone. This is like the NBN. This, people will never disconnect their internet. It's the last thing they'll ever do. They're only going to require more bandwidth. And I just think that, like I said, that contracted pipeline that they have ensures that they double their earnings over the next 3 to 5 years.
Ron, thanks for joining us on the show.
Thank you.
Well, coming up now is Jun Bei Liu from Tribeca Alpha Plus. Great to see you, Jun Bei Liu.
Great to see you, Peter. How are you?
I'm very good. I'm very good. But I know you're excited. This is reporting season, so a fund manager like you gets a chance to see how the companies you've invested in, how they're going, but also you get to maybe check out some companies you haven't got that you might like for the future. So I know you've given me a few to kick off with. So let's start off with Domain.
Yeah, look, Domain, we think it's always a fantastic result. On the day, share price initially started off was down a little bit because people were a bit worried about slightly higher cost, which is a consistent theme across most of the sectors that most of companies are investing more in the next 12 months, which is a good thing to do because demand's been strong. And also for Domain on the on the day of the result, obviously the lockdown is impacting the short-term housing listing, so creates a bit of opportunity, actually buying opportunity. And but since then we've seen investors piling back into the company, knowing that eventually we will come out of this lockdown, even though it feels like we may not. But housing market is very buoyant, listings being impacted, but we have seen every time when the lockdown gets lifted, the recovery in listing is very, very strong. So we know the earning will recover very strongly post listing, and this company is very well leveraged. The amount of revenue it generates per listing has grown substantially, and yet still way behind what real estate, which is the #1 player in the market, charges. So a lot of growth opportunity that is really just unique to the company itself.
Now, that's one of its biggest problems. It's always competed with REI, real estate group, and the bottom line is, are you saying that you think Domain is starting to play catch up quite competitively?
Oh, absolutely. Look, that's actually a really, really good point. That's right, that they are playing catch up, even though they're both playing in all markets in Australia. And yet Domain's market cap is only 1/8 of REA's market cap. But honestly, I think both companies are buy. It just Domain has a slightly higher growth profile going forward in the next few years.
Okay. Another one, an interesting one, is Domino's. Now, we know Domino's have been killing them with people locked up at home, so frustrated with life, they're just stuffing pizza down their mouth. Are you still saying there's potential there for Domino's?
Oh, absolutely. Just look at the earnings growth profile. I know it look expensive next year, but they have upgraded their earnings so many times. And I wouldn't be surprised the current earnings is still too low for the next few years. Because what's really driving this company at the moment, not only we're buying more pizza, is that they actually make it easier to buy pizza with their technology. And at the same time, they're growing more markets. So they're in Europe, they're doing well, they reach scale, which means every dollar of revenue will drop straight to the profit. And then in Japan, they're doing well, and they just bought into Taiwan as well. And potentially there's more coming through. And then they just done the calculation. They can roll out more store every year. And every store essentially just add additional growth. Despite share price rally into the result, on the day of the result, we still saw double-digit earnings growth for the next 3 years coming from analysts, and share price continue to move on with the earnings. So we believe this is one of the core holdings for a portfolio.
And I guess it's fair to say that even if one day a recession and a stock market crash comes along, that's a time when you want to eat more pizza because you're so depressed.
That's right. And then it's cheap. It's cheap, and it gets to you. You know who's driving the pizza to you, and then you've got that cool functionality. You track everything. So I actually think it's a great company. It's innovative, which is very important, because you just don't want to buy a company just because it's cyclical. Economy is going well, so the company will do better. You want a company to do better when in a good economy, also do better than its competitors, and continue to innovate is incredibly important.
Okay, another interesting company is James Hardie. Now we know it's benefited from the building booms here and in the USA in particular. You still like it going forward?
Yeah, look, still like it. Just incredible amount of leverage coming through. We know the housing market in the US is incredibly strong. Well, it's very strong in Australia and UK and then around the world. And we expect that to continue. But James Hardie is has been growing faster than the market for many, many years now. It continues to invest in its, better facilities, more capacity. And a few years ago, they actually have increased their capacity to keep up with the demand. And now it's reaping the the rewards. So, we expect this company to grow double digit for many years to come. And look, it's expensive, but it's not as expensive when you compare to other defensive quality businesses.
Okay. Just before you go, I'm going to be asking another fund manager about EML, which is a part of my ZEET stocks. It reported last week. Do you have a view on EML payments?
Look, I like EML, and the result itself, look, it was an okay result given the tough condition. The biggest thing overhang is the regulatory overhang. We're not sure what might come through. Just out of the proceeding out of the government over there. And then the business has slowed down somewhat because of the regulatory uncertainty. But what has reassured the investor at the result is that potentially it will be only a fine instead of complete loss of the license in that region. So net, share price come off 50% on the back of that regulatory uncertainty. It certainly looks like a good opportunity at this point.
So you're saying if you're prepared to take a risk that the penalty won't be as bad as the market initially thought, there could be a surprise upside, and the market would love to see that news, but you're going to have to wait for that news to come through.
That's right. We just don't know when that regulatory overhang will be removed, but perhaps you can apply a 70 to 80% probability that it will be a smaller fine than expected of loss of license or anything like it.
Okay, Jun Bei Liu, great seeing you, and thanks for your insights.
Thank you very much, and good luck.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. And that was Jun Bei Liu of Tribeca Alpha Plus. So joining me is Paul Rickard from the Switzer Report, and Paul is going to confess to having a new view on Telstra. Paul.
Well, it's actually not a new view, Peter, but I've been bullish on Telstra for a little while, as have you. But I started getting bullish at about 280. It's now touching $4. And I've got to say, I think there's a little more upside in it, even though it's been one of the best performing stocks over the last 12 months.
Yeah, you and I thought 275 would be a nice gain. Though I must admit, I haven't sold yet. So I'm glad that you're actually throwing some weight behind Telstra.
Yeah, I mean, it's one of those stocks that a lot of people invested 6-7 years ago above $5. One of the prioritisation levels, I think, was $7.40. Yeah. It's twice got down to about $2.50 and bounced off each time. We got bullish about 280. And you sort of think it's a company that has had zero earnings growth. Revenue's been under pressure now for the best part of a decade. But I sort of think that Telstra sort of now turned the corner and probably can go just a little bit higher.
Paul, like we know it's big on mobile, but also has it benefited from the lockdown in the sense that people are at home using telecommunication services like never before?
I think probably not, Peter. In fact, Telstra would probably argue that COVID's actually been an expense to it, because it's had to provide, a bit like the banks, subsidies to small business to keep them alive, not, been pretty gentle the way it's collected overdue payments, extra costs for staffing, had problems with a lot of call centres based in the Philippines, had to bring that workforce back to Australia. So I think I would argue that COVID's actually been an expense to it. Certainly it's benefited from use, but I don't know whether, because of, particularly in the mobile sense, all the plans are capped these days. In the broadband sense, it's just a retailer, so it doesn't really get any much benefit there. And even the wholesale side, I think people tend to, deal on contract. I'm not sure it's been a huge beneficiary of extra usage during COVID, but certainly the underlying trend of the digital economy, I mean, that's still long-term tailwinds in the way we use computers and communication devices. That's still a tailwind for Telstra ultimately.
Yeah, and also, I guess the bottom line is you're saying if the coronavirus lockdown period hasn't been great for the company, it's got a reopening trade benefit out there. And is that part of the reason why you're upgrading your price target?
Look, it's part of the reason. It's more, I just think that Telstra has perhaps turned the corner. And let me just sort of make that case. First of all, just to look back at the result about a week ago, it actually delivered on its guidance. That's a positive, always, to actually say what you're going to do. Secondly, it had actual earnings in the second half that actually exceeded the first half. So it actually had an earnings growth for the first time in almost a decade. Very, very small increase in the second half, but underlying earnings increased. Thirdly, it forecasts next year, and Telstra does provide guidance, that EBITDA would be up to about $7 to $7.3 billion, and that's up from about $6.7 billion this year. So that's a gain of about 500 million, 6 or 7% increase in earnings for next year, which is a positive. And then I think in the mobile space, Peter, which is not so much due to usage, but due to competition, it's actually benefiting from, the merger between TPG and Vodafone. The big four became the big three. That just takes a little bit of pricing pressure out of the market. And Telstra has recorded some revenue growth on mobiles. It's the average revenue, we call the ARPU, average revenue per user, went up. And again, that's the first time that's gone up in more than a decade. So there's signs of revenue growth. It's doing some good work on the cost side. And then finally, we saw early in the year, it sold about 49% of its towers business, and it got a phenomenal price for doing that. And part of that's coming back effectively through a share buyback. But it's also carved off all its infrastructure business into another company. So these are the things that actually own all the telephony exchanges, all the ducts, the vaults, all the stuff where all the cables go, the backbone of the whole communications network that the NBN uses to some extent, but certainly Telstra uses. And that business is called InfraCo. That could yet be demerged or sold, or they do a similar deal to what they did with the towers business. The timing on that's probably still about a year away, Peter, but certainly the analysts sort of ascribe some value to that and say that, again, a sale of part of or a demerger, that would actually be pretty good for Telstra shareholders and the Telstra share price.
Okay. So just quickly, Paul, a few companies reported today, and none of them got really a thumbs up.
Yeah, let's start off with Ampol. I mean, they're all actually down just a touch, Peter. Ampol was fairly much on as expected. Announced an acquisition of a business in the New Zealand market. That probably didn't do a lot for it. The interesting thing about the Ampol result was its refinery up in Brisbane is actually back producing earnings again. And you might recall that the government is now sort of providing a subsidy to keep the two refineries going. And so the Lytton refinery in Queensland was a positive contributor to earnings. Sales volumes are down, of course, because of COVID. We're not using as much petrol as lockdowns. And of course, so it's had impacts of COVID-19, but look, a pretty workmanlike result. I think there's attractive yield there, and maybe this is just a chance to top back up on Ampol.
Okay, let's go to Sonic next.
Yeah, another company I like, and probably underwhelmed a touch because its total dividend for the year of about 91 cents was a little bit less than the market felt, around 101 cents. Again, a fairly strong result, but the market was probably factoring more into this because Sonic, which of course is a pathology business, is not just in Australia, but it's about 40% Australia, 40% the US and Europe. It's done a huge number of those COVID-19 tests, right? I think it's done something like 60 million tests, and they get the lion's share. So when you go and get your COVID test in Australia, it's going to one of the, not all exclusively Sonic, but it's one of the major pathology labs behind it. I think the market had sort of expected that might be a bigger contributor to earnings. And look, there's a small contribution from it, but not as much as the market expected. Look, in a pullback, I think there's good value in Sonic too.
Okay.
And the third one, again, another one in our portfolios, Peter, is Reliance Worldwide, which of course is the plumbing company, well, not the plumbing company, the company that makes fittings and things for plumbers and people doing their own renovations. Again, most of the business started in Australia. Most of the business is done offshore in the US. They had a really good result, profit up by more than 100%, a big increase in dividend. and it's been one of the boom stocks for the last 12 months. I guess just a bit of profit taking. It's probably done better than the market expected. The dividend's a fraction higher. But again, you know, when you're sort of trading at a pretty heady multiple, had a big run up this year, the market's just seen it as an opportunity to knock it down 1% or 2%.
Yeah, but you're still sticking with it.
Yeah, still sticking with it. It was actually, just, you know, its outlook, I think, was pretty buoyant for the start of 2022. Notwithstanding, though, that of course, you know, with lockdowns and a lot of, you know, concern about what the Delta virus can mean, is also meaning what they, you know, describe as sort of supply chain disruptions in terms of getting parts, and of course, you know, with plumbers not able to visit houses potentially because of Delta, you know, they're also a company that you know, faces its own COVID challenges.
Yeah, it's going to be interesting to see the companies that in 2022 get a nice big rebound from hopefully getting back to normal.
Yeah, and I think we probably underestimate that pretty well most of our companies have some impact, either through higher costs, through just disruption to supply chains, or alternatively, you know, some hesitancy. I mean, lockdowns aren't good for anybody. And then they create artificial demand afterwards, of course, which makes it really hard to manage. So there are costs in doing this. And look, so far, I think as some of the data you've seen from Shane Oliver from AMP Capital, who tracks the stuff pretty closely, you know, there are a lot more beats than there are misses so far. So earnings are pretty strong. Haven't really seen the market take a lot higher. And I think that's maybe just because it's coming off, we've had such a strong run up, and we've had a couple of signs out of the US where maybe just a bit of hesitancy has crept into it.
August and September are very bad months for the US stock market, and we take our lead from the US. Paul, thanks for joining us.
Thanks, Peter.
So that's Paul Rickard of the Switzer report. And if you want to check out Paul's stories, particularly on Telstra, take out a free trial at switzerreport.com.au. That's your show for tonight. Thanks for joining us. See you on Thursday.